Hello and welcome to Business Television India. I'm Fatima Mahdi and you're watching Financial Planner. Joining me on the show today is Chethan Shenoy, who's the Associate Director and Head of Products at Anand Rathi Private Wealth Management. Chetan, I understand, manages the roadmap of all of Anand Rathi's product base on the company's vision and strategy. Chetan, it's a pleasure to have you right here on Business Television India with us. Thank you so much for being a part of this conversation. I'm going to start by asking you, from your vantage point, now that we've seen the general elections over such a decisive sort of victory as well, what are the kind of factors you feel the equity markets are going to be sort of sensitive to when it comes to a firm support of a bull run?
Yeah, I think, thank you, Fatima. Now that the large event of election is behind us, and I think, like you said, it's a decisive mandate. We could not ask for better from an election point of view or from a market's point of view. There are other, there are several factors, at least 5 factors that I am looking at, which, while we look at it, it gives us a feeling that we have a set platform for a possible bull run. And one of those factors is the macroeconomic indicators. If you look at the indicators in 2013 to now, look at GDP, it used to be 4.5%, it's about 6.5% right now, and steadily been growing. Even the quality of growth of the GDP, if you look at the inflation, then used to be 10% and now it's sub 3%, and it's been consistently depressed, and the government has been able to keep it at less than 3% for quite some time right now. It's building in tremendous amount of credibility on that front. If you look at the forex reserves, the country is at an all-time high with the $400 billion of forex reserves. Even the current account deficit and fiscal deficit, which used to be, fiscal deficit used to be 4.5%, it's about 3.5% and has steadily been going down. The current account deficit, which used to be about 4% is down to 3% right now. So, the macroeconomic indicators are definitely giving us tremendous amount of comfort. What has been not so comforting, the second factor of the 5 factors that I'm talking about, is the corporate earnings. I think that's been quite a dampener. It's not been up to the mark. Since 2014, if you looked at it, we have seen quite depressed earnings. The first 2 years, that's 14, 15, 15, 16, we saw negative growth. And then post that, we have been seeing single-digit growths. The analysts have not been getting the numbers right. I think there's a lot of, things that have been done in the economy that have led to the corporates seeing depressed earnings. And a lot of these things that have gone through as far as cleansing is concerned, whether it's demonetization, GST, NPA write-off, etc. Largely the feeling is it's behind us, and things could only improve from here. That's the feeling that's there in the economy. So we should see these things, while it has not been up to the mark for the last 5 years. The feeling is we should see a 14, 15, 16% kind of a growth over the next 4-5 years. And that again, therefore, is a feeling that it should be getting better, and that's a tick mark again. And that's the second factor, other than the macroeconomic factors, the corporate earnings, while it has been depressed, it should get better. The third factor is, of course, the valuation, which is very, very important. That again has been a factor which, valuations have been slightly elevated. If you look at the forward price to earning multiple, the long-term average of the forward price to earning multiple has been about 17. Currently, we are trading at about, after the run-up, we are looking at about 20-21 kind of a forward price to earning multiple. It is definitely higher than the average. But, the comfort here is that if the earnings come in, then the price to earning multiples will come down because the earnings have sort of justified the high elevated price to earning multiple. So therefore, that's the expectation. And it's not alarming while 2021 is higher. Alarming, I would say, is when you're looking at a 24, 25 forward price to earning multiple, which we saw in 2008. We saw that before that in 2000 as well. Both these times, when you look at, price to earning multiples which were at 24, 25, the markets came down crashing. But this time around it's at 21. We have seen depressed earnings for the last 5 years. So given that we are expecting earnings to get better, I would still say that the valuations are not alarming from that point of view, and we will still look at it as something that it's a good time to look at equities from that point of view. The fourth factor I would look at is, so liquidity, you're right. I mean, there's ample amount of liquidity sitting outside of the country. I mean, FIIs want to enter the country, but they've been, last year has been very bad for, FIIs have been net sellers last year. It's largely been the domestic institutional investors who have been, pumping in money. My guess is about 80,000 crores got pumped in last year from domestic investors last year. So largely it's been supported by domestic money. But this year, if you look at April alone, we have seen about 20,000 crores come in from FIIs this year. So my guess is with a decisive mandate, I think the FIIs should start pumping in money. And like I said, there's ample liquidity, and they've been wanting to look at new economies like India. And I think these are reasons that they have been looking for. And with one of the reasons out of the way, I'm sure there is reasons for them to look at allocating larger amounts of money. And I think the last factor is a very, very important factor, the fifth factor, the TINA factor. We've all heard about it. It's an aberration, for there is no alternative. I think for an Indian investor, gold, which has been one of the favorite investment avenues, has not delivered the kind of returns that they were expecting. So the love towards the yellow metal has reduced tremendously, and people are looking at alternatives. Fixed deposits have only that 7-8% kind of a return that they could deliver. So there's been a lot of money, and real estate, as you're aware, has been depressed. There's oversupply problem there in real estate. So there is no alternative. The fourth asset class, which is equity, and mutual fund, which represents it beautifully, has seen, just to give you a number, the SIP numbers we all know is 8,000 odd crores right now. I mean, just look at it, 5-6 years back used to be 1,000 odd crores. So there's this tremendous amount of interest that's coming in into equity markets. So I think both in terms of liquidity from a FII perspective as well as from domestic investors perspective, the TINA factor playing out, I think these are 5 factors that give us immense comfort in continuing to allocate in equity, other than of course the decisive mandate that we were talking about at the beginning of this conversation.
Sure. Chetan, very quickly before we close this conversation, are you basically saying that this is a good time to sort of stay invested in or invest in equities, and perhaps one should not really be very worried about valuations and short-term corrections? I mean, is that basically the view that we're looking at here?
Yeah, Fatima, I think you summed it up well. All that we are saying is equity markets are bound to be volatile and see some short-term corrections here and there. There is euphoria that sets in, and then the reality comes in when the earnings don't come in. So it is news dependent to a large extent, but directionally what we are saying is this is a good time to be in equities over the next 3, 4, 5 years with the decisive mandate that we have seen. That's what we are saying. So not only stay invested with your money, but also allocating new money steadily. It's a good time to be in equities.
All right. Thank you very much for that. That, of course, was Chethan Shenoy, who's the Associate Director and Head of Products at Anand Rathi Private Wealth Management, speaking to us right here on Financial Planner.